Hey, welcome back to Everyday Economics. This is the podcast that helps you understand the economic world going on all around us. Everyday Economics is brought to you by the Center Square Newswire service. I'm Chris Krug. I'm publisher of the Center Square, and Orphe Divounguy is my partner on the show. He's a PhD economist. Today is Monday, February 9th, 2026. And in this episode, we're talking about a whole bunch of stuff because there's just things happening from different directions. But we are going to talk about cooling of the job market. We're going to talk about the Federal Reserve and how the Federal Reserve is looking at things. And, you know, Orphe knows a thing or two about the housing market. So we're going to talk a little bit about what's going on in terms of the housing recovery. And, I don't know, whatever else you might gin up, Orphe. I mean, I'm excited to be back with you. So, you had mentioned, that there are like three macro threads that are pulling against each other inside of the federal government as we are sort of making sense for sort of what the Federal Reserve is debating how restrictive policy still is, in your words, a labor market that continues to cool beneath the surface, and a housing market that's showing pockets of improved affordability, but the transaction volume is low. Why don't we start with what's going on with jobs and job openings versus job seekers, that as you and I have discussed this over really, I guess, parts of the last 3 years, there's been really different dynamics where job seekers had an upper hand, and it feels as if in the last, I don't know, maybe year, 16 months, that it's gotten harder. And in the middle of that, you and I had talked about there are all these openings, but where are the jobs actually being filled, right? So why don't you give us a kind of current state of play for the job market and what's going on in jobs as you see it from the data?
Yeah, I mean, look, let's call it a crisis of confidence. Your businesses are not hiring. In fact, hiring rates continue to decline. The number of job openings has plunged. And in December of 2025, there were about 15% more job seekers than there were job openings, right? The complete opposite from where we were just a couple of years ago, where we had 2.3 openings per person, per job seeker, right? You had so many job openings out there that people were actually just quitting their jobs and moving on to a better opportunity. Those days are long gone. The Conference Board Employment Trends Index, right? They have this wonderful survey, shows that the share of consumers will report that a job is hard to get is the highest it's been since early 2021, right? So really a labor market that has cooled, mostly because most businesses they're just not hiring. They're not confident about what's going on in the economy. They keep saying changes, policy changes, whether it's tariffs, immigration, geopolitical issues, tax policy changes. It changes so fast. There's so much uncertainty that basically, they're hitting the brakes. And unfortunately, it means basically job seekers are not able to easily find work.
Let me ask you this: is there a particular segment of the jobs market where this is most prevalent? Are we talking about white collar jobs? Are we talking about blue collar jobs? Are we talking about technology? Are we talking about, I don't know? I mean, where do you see this?
Well, I mean, it's eased everywhere, right? Okay. There was a point where lower income, blue collar occupations were really on fire, and that has kind of slowed down, right? And you're seeing it also with kind of white collar occupations, white collar jobs. You're also seeing it in tech, of course. And a lot of the tech companies will talk about AI as being one of the reasons, but ultimately you're seeing it across the board, which is why I think a lot of it has to do with where the economy is and where people feel the economy might be headed, right? So that is the labor market story. At the same time, right, a labor market where people are not able to move on to opportunity is a labor market that is going to show up in mobility rates. If you're in residential mobility, if you look at tenants, apartment tenants, they tend to stay in place. They're not moving all that much. There's not much churn. If you look at households, homeowners, well, homeowners are not moving very much either. Part of it is, of course, this rate lock story, the story about, hey, I have a very low mortgage rate and I don't want to trade it up. But part of it is also the fact that ultimately, when am I moving to? One of the main reasons people move is a new job. And so if there are no jobs available out there, it makes it very, very difficult to see the type of residential mobility that we're accustomed to.
So all right. So we got it kind of dipped into housing there. I do want to talk about Fed Governor Chris Waller and his thinking around the rate, right? I mean, he's kind of he has a dissenting view, or he's outspoken in his position. But you raised housing, so let's talk about housing.
Why don't we make that point, because I think that's very important.
All right, well, let's do that. So
Fed Governor Waller said, is essentially that in the last 10 years we created on average 1.9 million jobs per year, right? In 2025, that was down to just under 600,000.
Okay.
And what he's basically saying is, look, after data revisions come, it's likely that we have created, in his own words, zero, zip, nada, nothing, right?
Right.
And so, to him, at least, the labor market looks so weak that the Fed needs to continue to ease policy in order to kind of offset whatever force is applying downward pressure on hiring.
Okay. Well, those are important. Those are important points, right? And when does the Fed
policymaker?
When does the Fed get another bite at the apple for the benefit of those that don't watch?
We don't have another decision until next month, right? Until March. And so we're going to have to wait and see. We're going to get a couple jobs report before then. We're going to get a couple of inflation reports before then. Yeah. And we'll have to watch those very closely.
All right. So then let's talk about the housing market. Obviously, you spent a ton of time on that. From your recent writing, you had noted that existing home sales, quote, bounced along the bottom, end quote, throughout 2025. 2026, I mean, this is the day after the Super Bowl. Congratulations to all our friends who like the Seattle Seahawks. You were very, very happy yesterday and still probably very happy today. But the Super Bowl is typically the kickoff. The Super Bowl weekend is typically the kickoff to the U.S. real estate market. That's what I've been told by my realtor friends anyway. What do you anticipate? I mean, you note that there is some affordability improvement being seen. So let's talk about what that means and then what you see for housing, at least early on this year.
Look, the reality is it's still very, very, very difficult for most people, right? When you compare to where we were just a few years ago, home values have increased a lot. Mortgage rates are hovering around 6%, so much higher, two, 3 times higher, at least twice as high as they were in 2021. So the overall housing cost, right? Insurance cost, all that stuff, maintenance cost, the plumber, right? Everything has gone up. Okay, so housing costs are high, right? Let's start with that. Now, the good news is over the past year, affordability has improved roughly 5% or so, right? The cost has declined. The typical mortgage payment has declined by about 5% or so. That combined with increased incomes increased roughly 3.5% over the past year. That's actually helped improve housing affordability.
Sure. People have a little more room.
they have a little bit more room for sure. And so as a result, when you have a little bit more room, you expect what you would expect, at least what the economic models tell us, is that you would get a small increase in transactions, the number of transactions in the housing market, right? So people coming on the market and sales, right? So new listings and sales. And you would also get potentially a little bit of upward price movement, right?
Okay.
Remember, over the past year, prices have been basically flat. They haven't increased very much. But we expect to see sales, activity, and prices to start moving up again in 2026. Now,
Okay.
that's the forecast.
Okay.
There is a big issue, though, with the forecast. And it's, will we resolve this current crisis of confidence? Could people feel secure enough about their future, their employment prospects, that they and the strength of the labor market to start making those long-term, those big decisions, like buying a house, right? And so that is really the kind of constraint, right, or the downside risk to the forecast that I just highlighted.
Well, thanks as always, Dr. O. Make sure that you read Orphe's Everyday Economics column each Monday at the Center Square and listen to what we have to say every weekend on the Center Square Radio Hour.